Hi students, I'm going to show you the walk you through the Excel spreadsheet for the slides I put up Wednesday night, June 13th. The case was Hornimann Horticulture. The one that everybody had questions about was this forecast, the projected 2006 financial summary, and it is based on the 2002 to 2005 historical performance. We're also using in Exhibit 2, which comes from the text, these ratios that show trends, and we can call them relationship here, revenue growth year over year. That's all calculated based on these numbers here. As you can see the calculations, I'm going to put them up here I'm going to click on them. So it's going back to this worksheet, Exhibit 1, and doing these, calculating the growth rate. One over the other minus 1 provides the growth rate. We're also going to use the data on margin, and we're going to use some other estimates, as we noted. So in constructing the forecast for 2006, we go back and get this 2005 history, and we typically start with revenue. It's a number, again, that most businesses can expect. They just base it on how much more can we sell. It's the top level research they'll do. And a 30% increase in revenue from 2005, where 2005 is 1,048,800. That times 1.3, or 1 plus this growth rate, and I'll click on here and you can see the formula up here. I'm going to drag that over there and you can see what's being used in it. That times 1 plus this number is equal to the 2006 estimates of revenue. So from that, we just look at these relationships here. I'm going to highlight these or show these selections here. The 52% gross margin, again, was taken from Exhibit 2. This is the number here, the gross margin from 2005. They're going to say, well, of course, the most recent year is the best predictor, the best number to use. Some businesses will use the average of the 4 years to be more conservative, in case it was one big year right before. And the gross margin, 52% of 1,363,000. In other words, that's going to be what they're going to sell. That's the profit margin they're expecting to make from it, is 709,000. Again, you can see, I'll push this F2 and you can see the numbers being used simply. After the gross margin, we can simply subtract the margin from the revenue to get what the cost of goods sold are. We do the same thing for the SG&A expense. Again, get the number from the 2005 table earlier, and we were given Margie's estimate of 46 for depreciation. That's just a plug. It's somewhere in the case. Operating profit, we simply follow up that gross profit minus SG&A minus depreciation is equal to operating profit for the business. Taxes, they're again using the 2005 estimate of 39%. So we're simply taking that 39%, take the taxes paid divided by operating profit to get 39%, and then going over here, we simply take that 39% and multiply it by the operation. So we look at this relationship and apply it to this number. So it could be a simple formula of saying that divided by this times this, but they're pulling the number here, the 39%. They're exhibiting the number here. Net profit then is simply, pre-tax profit or operating profit minus taxes. This is net profit. The more interesting part is the balance sheet. We don't really have a number for this yet. We're supposed to leave that blank, the cash. And the accounts receivable are going to equal 50.9 days of sales shown. We get again this number by going back to Exhibit 2 here, and we have that from the slide we showed that compared them to the industry and where this was the problem for them, 50.9. And by simply, that number is again referencing that. And how do we get the accounts receivable? Well, you'll see that it's a relationship to sales, that it is the um, um, this number, 50.9, times revenue divided by 365. So that'll be the amount of accounts receivable. It's simply the number of days times the revenue divided by days in the year to show that at any time or by year end they expect accounts receivable to be 190. Same thing is done with inventory. They know that that on average, or that at any time, there are 476.3 days of inventory on hand, or in their case, growing in the dirt. Process is, once again, to take that number taken from the 2005 history, multiply it times the cost of goods sold, because remember, inventory, you shouldn't add the profit to it. It should be based on cost of goods sold, and divided by the number of days. So those are the two big numbers that affect how much cash is needed. Other current assets, again, it's just 2% based on the 2005 revenue, so this is going to be 2% here. So in other words, if 20.9 divided by 1048 times 1,363.4, or 1,365,400, because we're doing this in thousands, is 27.2 in other current assets. So the sum of this number is current assets. Net fixed assets, again, this is determined by adding capital expenditures, which is this number here. I'll again highlight this. They take the assets from the previous year, add to it the new capital expenditures, and subtract depreciation. So it's last year's fixed assets, whatever they bought in the current during 2006, they expect to add. And again, this Maggie provided this estimate, subtracting the depreciation. Finally, total assets are current assets plus net fixed assets. So the company is going to need the 1,279. Now, we really don't have this number yet because I'm going to take this formula. This formula, as you can see, the cash is treated as a residual. So that number will populate once we complete this. So we would be leaving this as a, let's pretend that I'm going to do this in front of you, but I'm going to erase these numbers here, and you see what happens if you watch this. For example, you would set this up that whatever you have in total assets, you would have to equal liabilities plus net worth. So this number here will be based on the net profit from the expected net profit from 2006 added to the net worth in 2005 is going to be the increase in net worth, and everything else has to balance as a result. So we could start populating. We would leave a formula in here. You see, this formula is simply the balancing entry. It is simply going to be the debt plus equity, right, minus all other categories of assets. It balances it. Current assets, remember, it'd be double counting, so you don't want to get that. So it's going to be debt plus equity minus accounts receivable, inventory, other current assets. That was a slide I put up, and I'm going to, in class, actually it was the last question that is on the Blackboard question list. So that's what we're going to, that number has to be equal to, again, net worth is a number equal to net worth plus this liabilities is going to be subtracting these three, and cash makes the difference. So let's see how this works. With accounts payable, that's going to be 9.9. So I'm going to take equals 9.9 times the purchases right there, because that purchase number is given, divided by 365. So that's going to be the accounts payable. And the wages payable are going to be based on 2.3% of revenue. So I'll take equals to 2.3, this number here, times the revenue again. Okay? And other payables, we know again from looking at the 2005 numbers, is this 1.7% or 0.017 times the revenue. The current liabilities are simply the sum of these three. So we have the sum, we add it to net worth, and as a result, this number is populated because, again, it is a residual. That is that expression that we saw. Let's see if I can get the PowerPoint up very quickly. Well, it'll take too long. So if you have any questions, we can discuss it in class. I don't want to take any more than 12 or so minutes of your time with this. Thanks for paying attention. Take care.